Welcome to the Daily Insights that matter. The Securities and Exchange Board of India has introduced a set of new disclosure norms that are poised to have a far-reaching impact on more than 200 foreign portfolio investors or FPIs. These regulations are aimed at enhancing transparency and accountability in the Indian securities market and are anticipated to bring in significant changes in how FPIs operate and report their investment activities in the country. India boasts of about a massive 11,000 FPIs in the country. Out of this lot, 227 FPIs have over 50% of their equity investments in a single stock or a group of NSE listed firms. The amount invested by these FPIs is more than 1.98 lakh crore in 140 corporate entities, with the prominent ones being Adani Group, Hinduja Group, OP Jindal and GMR. Additionally, 122 FPIs had 100% of their holdings in one particular company or in a conglomerate. Under these regulations, overseas funds that hold more than 50% of their equity investments in a single Indian corporate group or have more than 25,000 crore rupees of equity assets under management in the Indian market will have to provide detailed information about their beneficial owners. However, government-linked investors registered such as FPIs, public retail funds and certain exchange-traded funds have been exempted from these regulations. Interestingly, there are 6 FPIs with over 25,000 crore rupees invested in Indian equities exempt from these additional disclosures and which will not get impacted. The new rules formulated following the Hindenburg Adani case are as follows. FPIs holding over 50% of their equity of assets under management in a single Indian corporate group have 10 trading days to bring down their holdings. Secondly, FPIs with over 25,000 crore of equities assets under management in Indian equities have 90 calendar days to rebalance their portfolio. Moreover, FPIs will need to make additional disclosures regarding ownership, economic interest or control in Indian companies. About 200 FPIs will be impacted by the SEBI's new disclosure norms, which will be effective from November 1st onwards. FPIs will be under the scanner whether they are set up in FATF compliant jurisdictions and the funds are coming in through regulated banking channels. FPIs will have to rebalance or diversify their portfolios so as to not come under severe actions like account blockages, restrictions or cancellation of registrations. The new disclosure norms will lead to significant emphasis on transparency, accountability and adherence to regulatory framework within the Indian equity markets. SEBI aims to prevent the potential misuse of the FPI route and to protect the interests of investors in the securities market. These measures collectively signify a significant shift in the operational landscape for FPIs in India. When we take a look at the current scenario of the Indian companies and their ability to manage their debt, we can observe a promising trend. This insight comes from an analysis conducted by Mint focusing on 382 companies listed on the BSE 500 index. The key metric that offers insights into this scenario is the interest coverage ratio or ICR, which essentially reveals how comfortably these companies can manage their interest payments on debt. The higher the interest coverage ratio, the better it is. In the recent June quarter, the ICR for these firms stood at an impressive 7 times. This represents an improvement over the previous quarter's ratio of 6.7 times. It's important to note that while this is indeed a positive development, it's still slightly below the ICR of 7.2% recorded during the same period a year ago. In the case of mid-cap companies, their ICR was at 5.5 times in the recent quarter. Now that might seem a little lower compared to the 5.69 times they had in the previous quarter, but here's the important part. It's still a significant improvement compared to the same period a year ago, where their ICR was at 4.44%. Now what's driving this improvement in the ICR? One major factor is the continuous drop in the prices of raw materials. This decline has translated into enhanced operating profit for these companies. In fact, the operating profits of these 382 companies saw a notable increase of 8.1% sequentially during the quarter. This is in contrast to the 3.6% rise in their interest costs over the same period. Additionally, the prudent financial strategies implemented by Indian companies over the past few years have also played a significant role. One of the key strategies has been the reduction of debt. Over the span of the last 4 years, these companies have made concentrated efforts to deleverage their balance sheets. The significance of these improvements extends beyond just financial numbers. by enhancing their operating performance through the optimization of raw material costs and effectively managing debt, Indian companies are safeguarding themselves against potential crises, especially in an environment of rising interest rates. This approach has been instrumental in preventing any unfavorable impact that could arise from a tighter monetary regime. With that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com.